Let's go to the phone with Bart. Bart, welcome to the show. How are you?
Hey, Lance. Speaking of the market losing money,
Yep.
I was going to open a IRA for me and my wife with pay my taxes just to reduce my amount, figuring the tax rates will be dropping next year.
Yep.
And I have an option to either go IRAs that are CD-backed or market-backed, and the CD is only going to be probably 2.5%. Do you think I should just go ahead and go with the market if I'm not going to draw it out for a couple years?
Hold on a second. So first of all, you got three things that are going on here. So you're going to open an IRA to deposit some money to reduce your taxes.
Right.
Okay. That's all you need to worry about right now. Right? So when you open an IRA, so you go to Fidelity, you open up an IRA account, and you're going to deposit your $5,000 or $6,000 into it. $6,500, whatever you're depositing in. So you're going to put $6,500 into it. That's going to go into a money market account. And you're done. At that point, you've got your tax deduction. So you don't need to do anything beyond that in terms of getting your tax deduction. Now, the second phase of that, at some point in the future, whenever you find the right investment, is to direct that $6,500 into another investment, whether it's a CD or a mutual fund or a stock or whatever it is you decide to buy. But those are two separate transactions. One is not dependent upon the other. I get this question a lot. People go, well, I'm opening an IRA and I have to buy something. No, you don't. When you put money into an IRA, it just goes into a money market account, and it can sit there for 20 years. Do you decide what to do with it?
Well, it'll probably be 5 to 10 years. What do you think is better if I decide to put it in a CD or go with the market?
Well, if you go with the market and you turn $6,500 down into $3,000, and then you've got to spend 5 years getting back to even, what'd you get?
Nothing.
There you go. Look, investing is always about a function of doing what is best for your money today. Here, let me pick this into a game. Do you ever gamble? Do you play poker? You play blackjack?
All the time.
Okay. So, are you a poker player or a blackjack player?
Both.
Okay. What's your favorite game?
Probably poker.
Okay, poker. So, we can play. Do you like Texas Hold'em? You like 5-card stud? What do you like?
Fine.
Huh?
Stud's fine. Stud or Hold'em, either one's fine.
All right. So all right. Let's just go with stud. So you've got your hand in front of you. You've got a pair of twos. I'm sitting across the table from you. I'm grinning ear to ear. How much are you going to bet on that hand?
Probably $20.
Okay. What's your normal bet?
How about 10?
Wait, you're going to bet 20 on a pair of twos? I'm grinning ear to ear, and your normal bet's $10?
I don't go by the people's facial expressions.
Okay. Well, I'm holding full house, so you lose.
Oh, well, then I'm, screwed.
Yeah, okay. So, but this is the same thing with investing. Look, so we invest when we have the right opportunity. Now, if you're holding the full house, you're going to bet a lot, right? Because you've got...
you're talking about you've got a full house in your hand. I thought the first two cards were a pair of twos.
Yeah, no, I'm talking about you've got a pair of twos, period. That's all you got.
Oh, for the whole hand.
Yeah,
okay. I thought you were talking about the first two cards. You see, how you get a full house on two cards?
So, yeah, no, I'm talking about... But the investing is the same thing, right? So when we want to invest money, we want to make sure that we're playing with a royal flush, right? We want the best opportunity that we have available to win that hand. Well,
that's what I'm asking you. Which one's the best?
Well, the answer today is if you said, if I'm going to invest, if I've got to buy something right now, I'm going to buy a CD because interest rates and security of money is going to outpace the return on stocks over the next probably year to 18 to 24 months. But I don't want to lock myself up into a position because if next month we have a big correction in the market, then I want to be equity-based. I've got to be able to move back and forth. So never lock yourself up into a position where you have no liquidity and no options.
Gotcha.
Right?
All right.
Appreciate the call, Bart.